Welcome to America's Heroes Group.
Welcome back to America's Heroes Group, our roundtable with our partner, Katz, Milanec. Today is Saturday, January 28th, 2023. January is Cervical Cancer Awareness and National Blood Donor Month. Our host is Kelley. I'm Sean Claiborne, the co-host. Our executive producer is Glenda Smith, and our digital media producer is Ivan Ortega of Scouts Honor Productions. And we have our partner on the line, David Milanec. He's a CPA and president and founder of Katz Milanec Incorporated and a military family member. We're going to talk about 2023 tax season started. You know that time is coming. Get your refund or pay your taxes. One of the two. How you doing, Dave?
Hi, Sean. Always a pleasure to be on with you guys. It's filing season has officially started. As of Monday, this past Monday, January 23rd, electronic filing can officially happen. Now, if you are a family who has a child tax credit or an earned income credit, you actually cannot get your refund until February 15th. There was a law called the FAST Act that put that into place to where refunds with child tax credits and earned income credits can't be issued until February 15th. However, you can still get your taxes filed, and if you have dependents, the earlier you can file them, the better, so that you can make sure you're getting to claim your dependents and no one else claims them on you.
Now, you mentioned they can't get it till February 15th. Does that include people that get those rapid refund, like loans and things like that? How does that affect those types of people?
Well, you just said it. That's a loan. So they get a loan against their refund, and then the whatever bank it is gives them money up front and then takes the money out of their refund.
So that won't be affected, but that might cost them more money, I would imagine.
Oh yeah, absolutely. They're paying like 200% interest on that or something.
Holy crap! Holy moly guacamole! That's a lot. That's like usury, man. How is that even legal? I don't even get that. That's crazy.
There's technically not a limit on what interest percentage can be charged right now. So I mean, they tried to pass something in the law a couple of years ago, but it never went through.
Wow. So what are some of the things that business owners are doing to get ready for 2023? Are you seeing business owners doing things differently in 2023?
Well, there's a couple of breaks that have either started to or completely gone away at the advent of 2023. The first is under the Tax Cuts and Jobs Act, as you know, several of the credits start to phase out, several of the credits and deductions. One of the big things for businesses that has started to phase out is the 100% bonus depreciation. That no longer exists. Now it's 80% bonus depreciation. Next year it becomes 60. Year after that it becomes 40. Year after that it becomes 20. Then it goes away completely unless Congress reauthorizes it. The other big one that just went away is the meals deduction, that when you eat out at a restaurant and it's a business meal, it was 100% deductible in 2021 and 2022. That was to get people to go back to restaurants after COVID. That has gone away now as well, back to 50% meals and deductions, meal deduction, unless you are a truck driver, in which case when you're subject to DOT regulations, you can get 80% of your meals and entertainment as a write-off.
Okay, so people have to be really careful about what they're spending if they're business owners, and that's one thing I think a CPA can really be helpful with, because, and I recommend this all the time, make sure you talk to a CPA about your taxes so you can make a plan for the year and save money. So instead of making these mistakes and finding out at the end of the year, I spent all this money on eating out, because I didn't know that. I didn't know that they changed the percentage again.
Yeah, it just changed as of January 1, 2023. And tax. I've been on here many times. I've told you listeners many times. Tax planning is very important. At the end of last year, the beginning of this year, you can always go out and do things like purchase assets and purchase items that you need within your business that will mitigate your tax liability. Also, you want to do the tax planning of making sure you pay in your taxes. In case your listeners don't know, January 15th was actually the final installment if you were making quarterly estimated to pay into 2022. You're supposed to pay it by January 15th.
So now this year, the RMD age also changed. Is that right?
They did a law at the end of the year when they passed the omnibus bill. It was in the omnibus bill. It was called Secure 2.0, and basically what that did is it did a lot of things with Roth IRAs and Roth 401ks, especially. Employees can now get the employer contributions placed into a Roth account. The employer still gets the tax deduction, but the employee has a Roth 401k at that point instead of a traditional 401k, which means it's after-tax money. So when they pull that money out, they're not taxed on it.
So previously, when you put your money into a Roth 401k, your money was always after tax, but the employer's matching was always pre-tax. So now it's all going to be after. Now it's all going to be after tax. Their portion and your portion.
You have to be knowledgeable about it. Oh. You have to be knowledgeable about it because you, as the employee, have to make an election. You have to go to your employer and specifically make an election to do that. Wow, once you do that, then it becomes Roth contributions instead of traditional contributions.
Okay.
But you have to make the election as the employee.
Okay. And what's the new RMD age?
I believe it went up to 73, and I think it goes up a couple more times.
Okay.
Over the next couple of years.
All right. So what's the number one question you get from taxpayers now as you're starting to do taxes at the beginning of 2023? I know you're very busy at this time of year. But what is the number one question you would say are the top two questions you get from your clients?
I would say the biggest one is, how can you save me money on taxes? And it's kind of a sad thing because we're at the point where it's almost a little bit too little too late. Because if we asked that same question a month ago, we're still in 2022. We have things we can do to reduce the liability. At this point, your profit is what your profit is. Whatever you made last year is what you made, and now you have to figure out how you're going to pay the tax on that. Now we can figure out a way to pay the tax on it if you don't have the tax paid out already, but there's less opportunities now for planning than there were even a month ago.
So a lot of the things you could do last year, you don't have those same benefits, those same opportunities to really save money. But that makes it even more important, I would think, to make sure you plan.
Now that actually saying that, there are a couple of things that you can still do in 2023 up until April 15th that you can have as tax write-offs. Those are putting contributions into a traditional traditional Roth IRA. Traditional Roth IRA, that's silly. A traditional IRA, and that's tax deductible, and obviously you pay the taxes on the back end. Or putting contributions into a health savings account. And the health savings account is actually interesting because it's the only account that you can put the money in pre-tax and spend the money out without having to pay taxes as well. You just have to spend it on health costs. So, for example, if you have a high deductible, actually having a high deductible health insurance plan is the only way to have a health savings account. But if you have one of those and you have a health savings account and you contribute to it, you can then use that money that's in there to pay medical expenses. As long as you do that, you never pay taxes on the money. And while it's in the health savings account, you can also invest it. So really, it's just completely free money, free growable money all the way around.
Do you anticipate that you'll see a lot of your customers getting bigger refunds this year, or do you see them getting about the same as last year or maybe higher?
Refunds are going to go down this year. I hate to be the bearer of bad news, but there was an expanded child tax credit last year that pushed refunds upward. There were tax breaks with the Tax Cuts and Jobs Act that are starting to phase out, and there are additional things. Basically, everything has adjusted away from the favor of the taxpayer this year. So I anticipate refunds will go down quite a bit. Now that said, it's not quite a bit, but it'll go down. Like, you probably see on average a 20 to 30% decrease in a refund.
Wow, that's a lot. That's a big.
It is, but that's the way the tax laws changed.
Mm-hmm.
Now that said, if you give us a call, 708-914-8220. We're going to do what we can to put the maximum amount in your pocket, and we can deal with all sorts of different cases. Like and we especially specialize in the cases where it's difficult to do and you don't know how to handle it. One example of that, if you have a 1099-C. What is a 1099-C? That's a cancellation of debt. So if you have a cancellation of debt, that's something where, like, for example, you got your house foreclosed on and you still owed money on the mortgage. Well, let's say you owed $150,000. That $150,000 now just doesn't go away. You think you're done when you do the foreclosure, right? That's not the end. Now the bank issues a 1099-C so they can write it off on their tax return. And then you have to, if you don't know what to do with it, you have to pay taxes on that $150,000 because technically the way the IRS sees it, you got an asset, you didn't pay back the loan that you used to get the asset, so now that becomes income to you, even though you don't have the asset anymore. So I've seen situations where people were staring down, $30,000, $40,000, $50,000 tax bills, even up to a $100,000 tax bill because of a 1099-C. But if you know how to handle it, if you know how to deal with one of the 5 exemptions under Section 108 of the Internal Revenue Code that gets rid of cancellation of debt income, you can actually completely eliminate that cancellation of debt income and turn a $50,000 tax bill into a $5,000 refund. And that's powerful.
Does that include people that file bankruptcies?
Absolutely. Bankruptcy is actually one of the 5 exemptions under Section 108 that gets you out of cancellation of debt income.
Wow.
If you're facing that situation, give us a call, 708-914-8220. We can get you out of it. Again, 708-914-8220.
So the child tax credits, walk us through that a little bit, because a lot of people ask questions about that because they don't. And I know that it's changed a little bit over the last few years. Is that money? I think did you mention that money is actually being decreased as well coming forward, or is that what's going on with that?
So last year specifically, because of COVID, they expanded the child tax credit and they gave people an advance payment on the child tax credit. So normally the child tax credit is $2,000 per child, and $1,400 of that maximum is refundable. The way they changed it last year is they made, instead of $2,000, it became $3,600 of a credit if your child was under the age of 6. And if your child was under the age of 17, it was a $3,000 credit. So they upped it by at least $1,000. Excuse me. And you also received, if you didn't opt out of it specifically and you had a child on a prior year tax return, they sent you an either $250 or $300 per month payment per child from July 2021 to December of 2021. And then the remainder of that, which was either $1,500 or $1,800, you still got as a refundable credit on the return. The entire $3,000 and $3,600 amounts were fully refundable last year, and that led to a large increase in a lot of people's refunds, because if you have 4 kids under the age of 17 and 2 of them are under the age of 6, that right there is $3,600, $3,600, $3,000, $3,000. That's $13,200 of tax credits that are fully refundable to you, even if you have no tax liability, even if you have no income.
Wow.
Now the way the child tax credit is, you can only get a maximum of $2,000 per child. So same situation, you're down to a maximum of $8,000 of tax credits, and only $5,600 of that is refundable maximum. And you have to have income in order to be able to claim it.
Now, we've seen interest rates go up a lot this year. So that has affected a lot of people's credit card bills. People maybe even getting behind on their payments. If they have a variable rate on their mortgage, that's going up. How does that play? Or do you see that in any way at all shaping or changing how taxes are paid? Because the value of their dollar is shrinking, but the tax bills are pretty much were already set last year. The tax amounts and tax rates and laws are already set. So what do you see that? How do you see that affecting people's household income?
Well, that's definitely going to take a chunk out of people's household income. I mean, we've seen inflation over the last several months change the game in terms of how how far a dollar goes, right? So with the interest rates being as high as they are, I saw them as high as like 8.5% for a mortgage. If you're paying that, that's obviously a lot more money out of your pocket than when we were talking about 4% mortgage interest. Now, the plus side to that, if there is a plus side, is that if you're paying that much mortgage interest, that mortgage interest is potentially tax deductible on your tax return. So you could also get an itemized deduction, or if you have a business, you could lease a home office to your business and take a percentage of your home completely as a deduction. So, like for example, you could take 25%, maybe even up to 50% of your home as claimed as business use, and then you could take your utilities, your homeowner's insurance, your mortgage interest, your property taxes, depreciation on the value of the house, cleaning and maintenance if you have it, like a lawn care service, or if you have a cleaning person that comes to your house, repairs, supplies for those repairs, everything like that can be deducted at whatever rate that you claim as business use for your household. That can help in situations where you have people with like excess property taxes in excess of $10,000. You can only claim $10,000 of property taxes on Schedule A. Well, we can move some of that to Schedule E as well and claim it there and get you the deduction back that you're supposed to have.
And do you see a lot of guys that are gig economy workers, like people that are doing Uber and maybe DoorDash deliveries and doing all these self-employed things, these gig economy guys? Are they missing out on some of these deductions because they're not really thinking about what they actually spend money on to keep themselves going?
Well, okay, so if you're a small business of any kind, and if you're doing stuff in the gig economy, you are a small business, whether you realize it or not. You are going to miss out on deductions if you don't keep your books well and know what your income and expenses are. And I mean, knowing your numbers is crucially important when you're running any kind of a business, but especially when it comes to tax time, if you don't know what your deductions are, you have to pay more in taxes. And the other key thing for that group of people, small business owners, is making sure that you have an election to be taxed as a small business corporation. That in and of itself can save you thousands upon thousands of dollars, even if you report the same amount of income. I was just sitting with a gentleman. I had lunch with him, and he told me that he made about $100,000 last year and paid a $30,000 tax bill.
Whoa.
I told him I could knock that down to $15,000 just by filing one form.
Wow.
And that's 100% true, because he's paying self-employment tax on that $100,000. He was paying about $15,000 of self-employment tax and about $15,000 of income tax. We take away the self-employment tax by filing an election to be taxed as a small business corporation, and now he doesn't pay that self-employment tax. He only has to pay the income tax.
Wow. Podcasters around the world, we're giving you pearls here, man. Listen to it. We're telling you some stuff that you guys need to know. So when you look at when people file their taxes as married couples, does it make a difference nowadays with the new tax code if you file married filing separately or married filing jointly? Is there any advantage to doing one way or the other?
Oh, 100%. You're way better off filing married filing joint in almost every case. There are very few exceptions to that rule. There are some exceptions, but I would say 98 to 99 times out of 100, it's going to be better to file married filing joint than it is to file married filing separately. Because when you're married filing separately, every threshold for a credit goes down. So I'll give you an example of that. The American Opportunity Credit, right? If you have a kid that's going to college, actually, you're not even eligible to claim that if you are married filing separate. If you're married filing joint, you are, and you have a threshold of $180,000 of income you can make before that credit goes away, and that credit is a $2,500 credit per child in college. $1,500 of it is a non-refundable credit, and $1,000 is a completely refundable credit. So even if you have no tax liability, you can still get $1,000 out of the credit. But you can't get it if you're married filing separate. Student loan interest is another thing you can't claim if you're married filing separate. And if you have a rental property, there's a maximum of $25,000 of rental deduction that you can take. It phases out for every $2 of AGI over 100,000, up to 150,000. $1 of the exemption phases out. When you're married filing separate, that exemption starts at 50,000 and phases out at 75, and it's dollar for dollar.
Wow. So what do you think?
Those are just some examples of ways that married filing separate really hurts you. The only time I really recommend somebody files married filing separate is if they are very uncomfortable with what their spouse does and they don't trust it and they think it's criminal, then you avoid legal liability that way. That's the only time I recommend it.
And sad but true. But I also see a lot of not CPAs, but people that file taxes seasonally that work for some of these H&R Blocks and things like that. Not knocking those outfits at all, but people that are not really true tax professionals, they do people's taxes. They get paid by the return that they file. So they sometimes encourage married couples to file two different returns because that's like two different checks coming in, two different bills are.
Well, yeah, but that means that they're looking out for their best interest. I'll tell you right now. As not only as a CPA, but as a business person and someone who has to do this stuff myself as well. Obviously, I have to file taxes just like everybody else. I look out for my clients as though it's my situation. I'm not going to recommend to somebody that they create more forms so I can charge them more money. That doesn't make sense to me. It makes sense to tell somebody to advise them in the best way possible. It's going to save them the most money and get them the most money back from what they've had to pay in and keep as much hard-earned money of my client in their pocket as possible. That's what I want to do. If someone else is looking out for their best interest, that you shouldn't be going to them. You should go to someone. An example of what I'm talking about is there are times where I've looked at a business and they said, "Oh, should I file an election B tax as a small business corporation?" And it didn't make sense for them. Now, if I wanted to look out for my interests, I could tell them, "Yeah, go ahead and file the election because then it creates an extra tax form that I could charge them extra for." But instead of that, I say, "No, it's in your best interest to file this in this different way that's going to file on your personal return, and you can keep it to one form, and you're not going to pay any more taxes doing that."
Wow. You're a good man, Dave Milanec. Very good man. Appreciate you for all the things you're doing. I'm going to ask you this last question before we run out of time. We might have a couple more questions in, but so what is the what would you say is the number one tax deduction or tax credit that people don't take advantage of? Like if there's one thing that or maybe one thing that most of us just don't know anything about.
Well, a lot of people don't know about the home improvement deduction. And there's a couple different home improvement deductions. There's one that's very small. It's like up to a $500 credit, but you can get it for things like if you buy appliances that are Energy Star, if you put new windows in, if you put new doors in. It's not a lot, but it's $500 extra that you can get. Another one, but also on top of that, there are certain improvements that you can make to your home. Like, for example, if you install a geothermal heating system. I know that's a lot of money and it's something that not a lot of people can afford. But if you happen to decide to do that or some other type of one that qualifies under the code for certain energy efficiencies, you can deduct up to 30% of that cost, and some of that is refundable.
Wow.
So it's really important to know that stuff when you're considering, like, to make home repairs. Can I get this as a tax deduction? Can I get this as a write-off? That's an important thing. What was the other thing I was thinking of?
What about EVs and things like that? Electric vehicles. Yeah.
Well, and electric vehicles, that is another example. They actually just changed it, but if you have to know which electric vehicle you're buying and if it qualifies for a tax credit. If you're going to go buy an electric vehicle, and part of the reason for that is you're trying to get some money back on your taxes, make sure you're getting the right one.
That's good to know. Because I would think I would have just bought one and said, I'm going to get my tax credit and filed my taxes and been disappointed.
Get paperwork from the dealership that says you get the tax credit.
Okay.
And then you know you're going to get it.
Okay. And then, finally, when people file their taxes, what's the time frame typically for when they should expect the refund? Because I know in the previous years, the IRS has been kind of late getting those refunds out. Is that going to be the same way this year?
The IRS processing times have not subsided. But the one thing I will say is they typically prioritize electronically filed current year tax returns. They prioritize processing those very quickly. So unless you're dealing with that February 15th deadline issue I talked about earlier, you can typically expect an electronically filed return. You can expect to get a refund between 10 and 21 days from the date the return is filed.
Damon Milanec, CPA, president and founder of Katz Milanec Incorporated, and a military family member. Thank you for your information and all your time.
Thank you, Sean. Give us a call, 708-914-8220. You need any help with any of this, we'll help you out.
Good advice. This is America's Heroes Group. We'll be right back.